Hello and welcome back to my YouTube channel. I apologize for the long duration I took before posting a video. It's been quite some time since I posted my last video here, but basically it's due to some few engagements here and there, but now I'm settled down and I promise to maintain the consistency, at least a video a day, so that we can enhance our forex education. Okay, so today I want us to look at a very simple strategy yet very effective. Okay, so and this is the bearish and bullish engulfing. Okay, the bearish and bullish engulfing. So we begin with the bullish engulfing. So with the bullish engulfing, the first thing they do is that they create what we call buy zones or demand zones, or what other people might refer to as bullish order block. Okay, the bullish order block. So basically how these kind of pattern forms, we need to have, or we want to see the first candle being a sell candle and the second candle being a buy candle. Okay, so the second candle should engulf. Okay, it should engulf the first candle. It should engulf the first candle. And the reason why we are saying a bearish or a bullish engulfing. Okay, so we have so that is the candle. Okay, so this is the pattern. That's how it should form. So if it forms in another way, then this is not a bearish engulfing. Remember the characteristics of a bearish engulfing, of a bullish engulfing. So one, for it to be a bullish engulfing, the first candle needs to be a sell candle, and the second candle needs to be a buy candle that engulfs the sell candle or the first candle. Okay, so once we have it in that manner, then we want to mark these regions. Okay, these are the regions that we want to mark. So at the top, you take up to the body of the first candle, and to the bottom you consider up to the lowest wick. So the first candle might be having the lowest wick, or the second candle can have the lowest wick, like in this case. So you take up to the lowest wick and mark that region. Okay, so this is the area now that we are calling a buy zone or a demand zone. Okay, or a demand zone, or basically what we call a bullish order block, which I will denote as plus OB. Okay, so basically that's how it forms. So once it forms, then we want to mark those key regions. Okay, so next we want to see price move up, okay, then come back to this region. Okay, so once price comes back to this region, that is when we want to start looking for what? For our buy entries. Okay, that's when we want to start looking for our buy entries, and we need to put our stop loss like 30 pips or 20 pips below the lowest point of this week. So from this week we can look like 20 to 30 pips depending on the volatility of the pair that you are trading. So this is our stop loss. Okay, so this is our stop loss. Okay, that's where we want to set our stop loss, right? So that is basically the bullish engulfing, and that's how we mark the region. So I said you want, after the bullish engulfing forms, we want to see this price, okay, move up, then come back to retest this region, and it is at this point that now we start looking for buy entries, because this is the demand zone. Okay, this is the demand zone. So also these they can form in a continuation of a trend. Now when we have this kind of an uptrend, and then we have another pattern here that is a bullish engulfing, we can have another pattern which is a bullish engulfing at that point. Okay, so the same case. So this is what we basically need to do. Okay, so you mark the regions. So this is the candle. Okay, this is the first candle, which is the sell candle. This is the second candle, which is the buy candle that engulfs the first candle. Okay, so those are just the wicks that I'm trying to draw there. So basically how we do, again, we just mark the region like I showed you. Okay, we mark up to the body of the first wick at the top, and then up to the lowest wick at the bottom, right? So now we want to see again the price move in the same manner. Price continue moving from this region, then comes back to this region. Okay, it comes back to this region, which you said is our buy or demand zone. Okay, all plus OB. Okay, so and then we want to be buying from this region, right? We want to be buying from that region. This is the region, the buy, demand, all OB. Okay, the buy zone or demand zone, all plus OB. Okay, so basically in the first scenario, this happens when we have a downtrend. Okay, it happens when we have a downtrend, and the bullish engulfing here is acting as a reversal. So the market is reversing from the from a downtrend now to an uptrend. Okay, it's reversing from a downtrend to an uptrend. So once we have this, then we can have it form again as a continuation. Okay, as a continuation of the trend. That is when it forms at the middle of the trend, and we just trade it the same way. We trade it the same way we trade below here. So this is our stop loss. Okay, this is the area where we want to set our stop loss, like 20 to 30 pips from the bottom of the lowest wick. Okay, from the bottom of the lowest wick, right? So that is the bullish engulfing, and then we look at the bearish engulfing, and we will go to the charts to look at how price performs in those regions. Okay, so the next thing we want to look at is the bearish engulfing. Okay, bearish engulfing. So with the bearish engulfing, for it to be a bearish engulfing, it has some special characteristics. Number one, the first candle needs to be a buy candle, and the second candle needs to be a sell candle. Okay, the second candle needs to be a sell candle. So I'll just shade the body of the second candle to signify that it's a sell candle. So let me put the wicks so they can have the wicks. Okay, that is the upper wick for the first candle, and the lower wick for the first candle. Then you can have upper wick for the second candle. Okay, and upper wick, lower wick for the second candle. So in that manner. Okay, so once this kind of pattern forms, again we just mark the same way. From the top we take up to the highest wick, then from at the bottom we take up to the body of the first candle. Okay, so we mark that region, and this is what we are calling the sell all supply. Okay, all supply zone, or basically it can also be referred to as a bearish order block, which I'll denote as minus OB. That is the bearish order block. Okay, so how we trade this kind of pattern, we wait for the price. Okay, we wait for the price to drop. Okay, we want to see if the price drop, and then price comes back to this region, and that's when we want to now focus on selling. That's when we want to focus on selling. Okay, so that is how we take our sell entry from this region, and then we can have our stop loss like 20 to 30 pips from the top of this wick. That is the highest wick. So around that point, that is where we want to have our stop loss. Okay, that is where we want to set our stop loss. So basically at this level, you find that the prices were in an uptrend. Okay, and at this point, this bearish engulfing, remember, they can either be signify reversal or a continuation of a trend. So at this point, they signify reversal. So when we have the trend in a continuation of a trend, that is when we are already in a sell, that is in a downtrend, and we have another bearish engulfing formed along that point. Okay, so let me unshade the first candle so that they can appear different. So the first candle is the buy candle. The second candle, it's a sell candle that engulfs the first candle. Okay, so those are the characteristics of a bearish engulfing. If it's not that way, then it's not a bearish engulfing. Okay, so don't confuse yourself. You need to be very careful when you're trying to identify these candlesticks. Okay, so in a continuation of a trend, basically we just do the same thing. We mark the regions. Like we marked in the first instant. So this is the area that I want to mark up to the highest wick at the top and up to the body of the first candle stick at the bottom. Okay, so this now becomes the supply, okay, or sell zone, or bearish order block. Okay, so basically we trade it the same way. We want to see the price drop, then come back to retest this region, and now we begin looking for our sell entries. Okay, we begin looking for our sell entries. So we said that our stop loss, you can set it slightly from the top of this at the highest wick, maybe 20 to 30 pips, depending on the volatility of the pair that you trade. Okay, depending on the volatility of the pair that you trade. Remember, this strategy can be used in all pairs. Okay, in all currency pairs, with gold, stocks, everything, you can use this strategy to trade the market. It's very effective. So that's the bearish engulfing. That's the bearish engulfing, and that's how it basically forms. Okay, so the next thing that I want us to do, I want us to go to the charts. And look at various examples, how the market has been performing using the bearish and the bullish engulfing as they create the sell or the buy zones. Okay, the sell or the buy zones. So let's dive into the charts. So here we have a bearish engulfing. We have a bearish engulfing. So this is the pattern. We take up to the top. We said we take up to the top of the wick. Okay, we take up to the top of the wick. So I can use, basically you can use the lines, or you can use the rectangle. So I take up to the bottom of that wick and up to the body of this first candle. Okay, up to the body of the first candle and extend. Okay, and extend it, right? So this is the candlestick pattern here. This is the first candle, which is a sell candle, a buy candle that, and then we have a sell candle that engulfs the first buy candle. Okay, so that makes it to be a bearish engulfing, and this is the zone that we are interested with. Okay, so you can see the price went, and immediately after the candle formed, the price came back at this point, or even at this point. Okay, so, and the prices, like you can see, the prices dropped. Okay, from that region, the prices dropped around 183 pips. Okay, 183 pips. If this could be my first target, basically that's around 109 pips, which is quite good. That's quite a good number of pips. So when you're trading again these patterns, the first thing that you need to know, the first instant or the first retest is always the best. We want to trade these zones when they are fresh zones. So at this point, I will not engage in the market because this is the second time that the market is coming back to this region. So this is usually 50-50. It's not guaranteed. Okay, so always trade these zones when they are fresh. Okay, when they are fresh. So this creates now what we call the demand, the supply zone. Okay, the supply zone or the sell zone, or what we call the bearish order block. Okay, what we call the bearish order block. Then we have another candlesticks pattern here, that is the bearish order block. The bearish order block, or what you're calling the the bearish engulfing. So we have a buy candle and the second candle, which is a sell candle that engulfs the first candle. So we mark that region. Okay, we mark that region, and we wait for the price. Okay, we wait for the price. Like we said, remember, we are marking the we need to have like 20 to 30 pips stop loss. So you can see from this region, okay, from that region, the market went up here. That is around 19 pips. Okay, so if we can have a stop loss basing on this high, so we look at the previous high there, and we can have our stop loss around that point. Okay, we can have our stop loss around that point. Okay, so once you put your stop loss around that point, then you will wait now for the market to go down. Okay, once you've marked this region, you wait for the market to go down and then come again to this region. Okay, and you can see once the market reached this region, how the market behaved. Okay, you can see there was a sell. Okay, there was a sell, a very huge sell. Okay, a very huge sell. And the reason why the market did whatever it did here, it's because basically we have two areas, two patterns that are close together, because here you can see we have the bearish engulfing again. So we have a bearish engulfing at that region. Okay, so the reason why now the price had to respect, when you see this kind of scenario, when we have two bearish or bullish engulfing closely together, the price will tend to jump all the way to the upper bearish engulfing. Okay, all the way to the upper engulfing or the supply zone. Okay, so the reason why this price jumped all the way to this point, and now this tells you that this is always the best to trade. Okay, instead of the first one here, you can always go for the second one when they are closely together in this manner, and you can see the price sold for quite some time. Okay, the price sold for quite some time. So again, we have another bearish engulfing. We have another bearish engulfing at this level. So this is the first bull candle, and then we have a large bearish engulfing. We have a large sell candle. So we can mark this zone to be a bullish engulfing. Okay, you can mark that zone to be a bullish, to be a bearish engulfing. So you can see after the price, after the this candle, bearish engulfing candle formed, the price had to go back all the way that to this, which is our sell or supply zone or the bearish order block. And you can see after retesting the price, then after retesting that region, the price dropped like 156 pips. Okay, so this could be your target here. This could be your target, and you can see it was achieved. That is the previous low here. The market had to drop down here and take liquidities before retracing back. Okay, so these candlesticks patterns are very effective. They are very simple but very effective. Okay, so let's look for more examples. So here we have a bearish engulfing, we have a bullish engulfing. So the sell candle, and then the big buy candle that engulfs the first candle, which is the sell candle. So as always, we mark that region. Okay, we want to mark that region. We take up to the lowest wick and extend. Okay, so you can see how the prices behaved. So the price jumped up. Okay, so we don't basically chase the price, but we want to wait for the price. We identify these areas and mark them out and wait for the price. So you can see once the price came back to this region, the price reacted, and it bought for around 189 pips. Okay, 189 pips, which is quite a good number of pips. Okay, which is quite a good number of pips. So this is where I would want to have my first take profit at that point. And you can see the market respected the strategy. The market respected that strategy accordingly. Okay, the market respected that strategy accordingly. So again, here we have the same pattern. We have the same pattern. This is a sell candle, and we have a buy candle that engulfs the sell candle. And then we mark that region. Okay, we mark that region. We mark that region, and you can see exactly how the prices did at this point. Okay, so this was the first retest. Okay, so that was the first retest. The price went up and then came back to that region, and it went up 85 pips. Okay, it went up 85 pips. So our target, could you look at the previous high, and that's when that's where you want to have like your first target. Okay, that's where you want to have your first target. So let's look at one more example of bullish engulfing. So this is another example, a very good example of a bullish engulfing. So we have the sell candle here, and a big buy candle that engulfs the sell candle. So as always, we mark that region. We mark that region, and so that's how we mark it, and we extend. Okay, we extend all the way to that point. Okay, so you can see the price went up. Then it came back to this region, and you can see after the price reached this region, you can see the reaction. Okay, there was a big buy. Okay, there was a big buy. So this is the region that we want to mark. Remember, we said that our stop loss should be slightly like 20 to that pips from this region. So this is GBP/USD, so we can have like that pips. Okay, that pips. So that's around that region. Okay, so this is the area that we want to set our stop loss. So you can see the market did not hit our stop loss. So the market respected the region, which is the buy zone or the demand zone, and it went all the way up. Okay, it went all the way up. Basically, an estimation of around 524 pips. Okay, 524 pips. So guys, this is a very simple yet effective strategy that you don't want to miss out. This is the strategy I use to trade the market. It gives me very nice entries, and I believe it's the simplest that you can ever have. Okay, it's the simplest that you can ever have. Remember, my goal has been to simplify Forex to the best way possible, such that even a beginner, anybody who is new into Forex, can be able to understand. Okay, so ensure that you backtest these strategies, you mark them out, practice them in your demo account, and I guarantee you, with this strategy, you'll be very, very profitable. These strategies actually can give you a risk to reward ratio, of 1:3. Okay, of 1:3 and above. Okay, so when you're trading this strategy, ensure that you go for a risk to reward ratio of 1:3 and even more. That is, you are risking $1 to make $3. So if you have a stop loss of 30 pips, then shoot for 90 pips, take profit. Okay, shoot for 90 pips, take profit. I shall teach that in another video, but this video was basically to show you how bullish and bearish engulfing can help you identify key demand and supply zones, or what we call bullish and bearish engulfing. And they are very high probable. Okay, they are high probability areas that you want to focus on buying and selling the market. So until next time, keep safe, but ensure you are backtesting these strategies and practicing them in demo, so that you can become a pro in them. Okay, so thank you so much, and see you in the next video.